Alessia Berardi, Head of Emerging Markets Macro Strategy Research and Amundi Investment Institute, joining us to throw light on exactly that. Alessia, great to have you on the show. Let's first talk about what's happening in the US and what the Trump 2.0 regime is going to mean for the world and, of course, the US dollar.
Thank you for inviting, and happy to be back to talk to you guys after following and participating to the CFA, India CFA Society conference 10 days ago. So, interesting times. We had the inauguration. So let's say we didn't have the first day actions that some were expecting, so a sizable number of executive orders, but the agenda is very well alive. So trade, immigration, tax deregulation, these are the priorities of the administration, and we had first sign of these priorities coming up. So we had the interest of the authorities is concentrated towards the neighboring countries, so Mexico and Canada, China in terms of trades, policy memo on trade, but maybe you are alluding to the fact that one of the most important aspects and announcement was related to the Stargate process, so continuation of policy towards support towards strategic sectors. And this is important for the equity market in the US and for a continuation and persistent US exceptionalism.
But Alessia, is it also going to translate into a continuation of a stronger dollar, or do you think that may peak out sometime this year?
We do have some expectation that the strong dollar will remain, even as a consequence of some uncertainty attached to the unfolding of the policies, right? Because we do not have yet a clear path in front of us. Having said that, we do expect that the US dollar is going to depreciate moving further during the year, and indeed our targets is for higher level, for example, against the euro. We do expect US dollar getting higher towards 110 by the end of the year.
That's the view as far as dollar is concerned. Hi, Alessia. This is Anish also joining in the conversation. Wanted to shift back the focus of the conversation to India a bit, because we have been seeing an exodus when it comes to the FII flows from India, part, of course, on account of the dollar strength that we talked about. When do you anticipate a reversal? Because growth is moderating a bit. Is that something which is concerning the foreign investors?
No, you are perfectly right, and you are exactly spot on the two aspects, because when we look at emerging markets, and India is an example in case, we look at global financial conditions and we look at domestic conditions. So India and equity markets in general in emerging markets needs to see more appetite towards emerging markets assets by global investors, and that has a lot to do with global financial conditions easier than what are right now, and that relates to dollars, yields, and Fed policy expectation, I would say. Not only to policy making by the US administration. On the other side, the other aspect is more domestic. And thanks God, India is a country, is a market that is very much domestic oriented, and growth earnings perspectives are what they are relevant together with valuation. So we have more appealing valuations. I don't expect that the trend for growth in India will go down. So economy moves in cycles. 8% maybe was a peak of a cycle. I don't expect growth in India below 6%. So again, I do expect growth recovering in India, and between 6 and 7% is a sustainable level, considering the economic conditions. Therefore, earnings returning, better valuation, the rating of the valuation that we have seen more recently are drivers supportive for the Indian equity market moving forward.
Point taken. So you're talking about how India is a domestic economy, and that, of course, is working out well. But if I have to zoom out and look at India in a global context, does it feature high in the pecking order of an ideal investment allocation?
Say yes. For partly for the reasons that I've said before, a growth that is between 6 and 7% with the earnings expectations that are still there, even if they've been declining. India is standing out across emerging markets and in general across the world in terms of bright spot. And in terms of global perspective, when we rank countries' vulnerability, even vis-à-vis new changes in trade or, let's say, external shocks related to a new wave of tariffs at global level, India again stands out as an insulated country and therefore a safer country. And in this sense, so external vulnerability, but even domestic resilience make India still a very appealing story.
Alessia, in the very near term, though, while India has always been known as a consumption economy, their entire consumption theory has gotten challenged. I mean, not just that the stocks are overvalued and overheated here in India within the listed space, but also that there is a rural as well as, signs of an urban slowdown as well. What do you think is going to be the next theme for India investment?
I think one of the most important theme, in the short term, we will have the budget presentation soon. Again, the budget, I think, will continue to show the same kind of messages. Fiscal consolidation on one side, but support to growth on the other side. And growth support comes not only through capex that I expect will be confirmed again in the new budget, but going towards what you were saying, I expect more support even on the consumption side. So income tax tweaking, so these kind of measures that can be highlighted in the budget will show the commitment of the government to support growth not only through capex but even through consumption. And we have been seeing already a sign of a more comprehensive support to the economic growth, not only related to capex, already in the past fiscal figures.
What do you think of the growth versus value conundrum right now, Alessia? And if you had to, recommend in terms of putting money to work somewhere, what would be the right asset allocation this year? Because it's going to be a lot more volatile, at least the way 2025 has started so far.
No, you're perfectly right. So our outlook for this year, indeed, not by chance, was titled Bright Spots in a World of Anomalies. So we are in a late cycle phase. We still like risky assets, credit, equity, income opportunities, so emerging markets, bond. But there are a lot of anomalies. So this year will be a year where you have to play more dynamic allocation, and you need to reconsider and to reassess the macro framework quite often. That means that during the year, even strategies like risk diversifier strategies related to risk on liquidity, on higher volatility, macro and geopolitics will be necessary in your asset allocation.
For far long, or rather last 6 months at least, people are really sort of betting on China as a bottom-up story. Now with the tariff implementation of 10% from Feb 1st and always this sort of overhang and threat looming over China as to what's going to be Trump's next move, tell me whether that entire rationale gets challenged. And is China a clear avoid then?
Yeah, the policy pivot that we have been seeing in China late last year, around October, is still very much there. So we don't think that the story has ended last year. So we will have more details at the beginning of this year, maybe in March at the next relevant policy meetings, and in particular even more when we will have a clear approach, a clear stance by the U.S. administration. So there is clearly no doubt on the fact that China is ready to put more money on the table, either because the economy has been suffering, particularly the domestic part of the economy, either because now you have to face and to offset a possible external shock. So in this sense, we have seen some, let's say, cyclical rebound in China end of last year and somehow even beginning of this year. Trade numbers were good, not only in terms of exports, but they were good even in terms of imports. So meaning that a cyclical rebound was actually there. So many parts are moving. Fiscal package and fiscal stimulus will be probably one of the catalysts to look at for investing in China.
So just before we let you go, we talked about how budget, of course, is a big event to watch out for in India. But for the global markets, the US Fed decision and the central bank trajectory also remains important. I think the US Fed meeting is lined up for 28th, 29th. But a large part of Street is now penciling in a shallower rate cut and a slower rate cut cycle. Are you part of that consensus?
Let's say that as Amundi Institute will remain more dovish than the markets. So we do expect the Fed cutting more than what the markets is discounting right now. And this is consistent with our macro backdrop of some normalization in terms of US growth moving towards the potential and inflation moving finally closer to the target.
Okay, Alessia, on that note, we'll let you go. Really appreciate you making time and speaking with us. So that's the latest coming in from the House of Amundi. They are saying that growth is normalizing in India. But of course, 8% was a bit of a peak. 6 to 7% is something that might just continue. And the government's focus on fiscal consolidation as well as infrastructure development and consumption is going to be the biggest driver.